Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We're going to discuss what is going on here. Huge move just over the past few days here. We've covered a lot of ground very quickly. We're going to talk about a lot of things in this video, whether we are seeing signs that this is truly a sustained recovery, that we have seen a significant bottom in the market, whether June 16th was the low that won't be revisited for quite some time, or whether we should expect the market to fail once again, just like it did in March, just like it did in May, and come back to undercut these lows. We're going to dive into the data to find out what the charts are telling us today. Now, if you're interested in following these crazy markets with us, don't forget to smash that subscribe button. And if you enjoyed this episode, don't forget to click on that like button. It really helps our videos out a great deal. Before we dive into the more technical aspects, I want to quickly take a look at this chart to give you guys the context, give you guys the longer term picture, because the markets are never black or white. You have to take into account the entire story, have the broader view of what is going on, of where the financial markets are currently positioned. And this is a chart of corporate profit margins, right? So profit is revenue minus costs. So increased profit margins generally means that companies have increased their revenues relative to their costs. And you can see here, this chart goes back to 1947 to show you guys the entire picture of corporate profit margins. And ever since 2001 here, we've had corporate profit margins expand in a very significant way. Now, what does that actually mean for the S&P 500? The way we look at this is that the expansion of profit margins has led to higher earnings throughout the last 2 decades, right? And so this is a big part of what has contributed the bull run that we've seen since 2009 here. It's that companies have generally had a high profit margin leading to high earnings, and so you can see the S&P 500 trend up very violently. Another great example of that is 1959 to 1968. A decade of very high profit margins led to a massive bull run on the US stock market. Now, unfortunately, that means that we're currently very high. So all those very attractive profit margins have been priced in, and they're vulnerable to downside, right? If profit margins begin to contract, you're going to start to see earnings decline and the S&P 500 to underperform over a longer period of time. And the perfect example of that is from 1968 to, let's say, 1980 here, where you had a decline in profit margins, and that coincided with a secular bear market on the S&P 500, where a lot of investors got hurt over that decade. There will be a moment where we have to start looking to protect ourselves from this type of very hostile environment for US equities. But as most of you know, the picture today, the picture looking out 6 to 12 months is very likely different. There is a fundamental bullish case right now on equities that we've been talking about for months now, and that is the market that's starting to anticipate peak inflation, peak yields, right, with the 10-year yield that's already quite a bit down from its recent highs, and potentially the Federal Reserve that starts to adopt a less hawkish tone. That's what the market is anticipating today, and we're currently already around 12% of that 16th of June low, right after that big capitulation event. In fact, if you were a member on our website at gameoftrades.net on the 16th of June, you'll have seen this article and video here where we highlighted this indicator here, the S&P 500 stocks above their 50-day moving average, right? This is a breadth indicator, so it shows you the number of stocks that are above their 50-day moving average. And this indicator on the 16th of June was giving us a major signal of capitulation here, where you essentially only had 2% of stocks above their 50-day moving average. And if you take a look at what we wrote on that article, this is one of the key indicators to watch for investors looking to position on exceptional risk reward. We've only seen two readings similar to the ones we got today, 2008 and 2020 during COVID. These also happen to be the most attractive buying opportunities of the last 2 decades. And perhaps this is going to turn out to be another one of them. But not everybody has the same investment style of buying on such aggressive moves, and that makes sense, right? Everybody has their own strategy, everybody has their own methods, and a lot of investors prefer waiting for confirmation that we are in a recovery, right? Now that has its advantages and it has its risks. The advantages being that you increase the odds that you'll be in the green throughout your entire investment. But the risk being that if you're wrong, you're potentially buying at a much higher level. And so if you're wrong and the stock market does begin to move back down, then you've got a lot more risk here than the investor who positioned on that 16th of June low. I'm not here to tell you what to do. Here we just take a look at the data, try to take a look at it as objectively as possible and see what the risk reward is on different setups. So that's exactly what we're going to take a look at with you guys today. Is the market today telling us that this is a sustained recovery, and that is the market strong enough to confirm that the June 16th low was indeed a significant bottom that will not be revisited? One of the things I love to take a look at that is another measure of the breadth, and that is the percentage of stocks above their 200-day moving average. Typically on a rally, on a recovery, you want to see most stocks participate. Most stocks should be rallying and coming back above their 200-day moving average, right? Look at COVID. This was a very powerful recovery off that low, and this doesn't happen very often. So let's take a look at that. You can see what happened here from the June 16th low to where we are today. Very big move here. We went from around 10% of stocks above their 200-day moving average, 11% we'll call it, and now we're at around 30% of stocks above their 200-day moving average. So let's go on the weekly chart and take a look at how many times we've had a move from 11% to 30%. And you can see, you can spot that very easily here. 2020 again was one of those moments, so we can put a vertical line here. 2019 here was one of those moments. Here in 2011, right here in September 2011, you had that same move. And then again in 2009, right here, you had that same move from very low to very high. So let's take a look at the SP 500 on top of this chart and see what kind of performance that leads to. And of course, we'll add a vertical line to today. Obviously, in 2020, it led to a major bull run. In 2019, it led to a major bull run here. In 2011, it led to a major bull run. In 2009, it led to a major bull run. This is a flawless signal. This is absolutely beautiful and does significantly increase the odds that this was indeed a significant bottom that won't be seen again for quite some time. Now, again, as I said at the beginning of the video, we have a long-term bearish case on the market. So we do think it's entirely possible that, at some point in the next 5 years, we'll be back at these levels. But if your time horizon is 6 to 12 months, then this is painting a pretty optimistic outlook. Now, unfortunately, we don't have data going back further than this. This is actually something we're looking to work on and develop our own indicator that goes back a lot further than this and actually analyze how well this indicator works during secular bear markets to see if it provides as accurate signals as during this period that we're looking at here. One of the things that I find promising is that we didn't see this type of development between 2007 and 2009. So this is not similar to what we saw throughout the entire bear market in 2008, including the bull trap, right? Now, anything can happen, right? Anything can happen for the first time. This is all data. This is all playing the odds, and we can't predict what the market is going to do. We can only position based on what the data is telling us. Now, I do have the flip side to this data, because if we go back a little bit further, go back to 2011, let's take a look at this reading here, because I find it very interesting. It's very similar to today. We had that low in August 2011, and then you had that big recovery throughout the month of August in 2011. So that signal here was triggered on the 29th of August. So let's see the S&P 500, what it did after the 29th of August. You can see it failed and came back down to retest that previous low. This is something to keep in mind, because if we take a look at what type of move that was, this was not a very friendly move from that top to that bottom. That was another 12, almost 13% move down from the date of the signal, right? And that goes back to what we were discussing just a couple of minutes ago. That's the risk of waiting for a sign that the market is recovering, because you might just get whipsawed as the market retests that low. I think everybody should be aware that this is still very much a possibility. 2022 has been the year of whipsaws, the year of false starts. So we're not immune to that today again, especially considering the fact that we have evidence that this signal that we just took a look at didn't play out very well in the couple of months after in 2011. Now I want to show you one more chart here, and that's the 4-hour chart. And that's the 4-hour chart. Hopefully this video is not expired by the time that I post it. But in any case, this really doesn't have a major weighting to the analysis. This is just something for you to understand where we are in the short-term technical standpoint, because I know a lot of people watching these videos are very focused on the day-to-day price action. Now, that's not something that we incorporate in our strategy. If you are focused on the day-to-day price action, then you have to look at these shorter term time frames. And this is the RSI, the momentum indicator, that's telling us we're very overextended on this time frame. Let me just highlight the previous readings where we saw such a level of overextension. We had one in March 2022. We had one in May 2022, both marking the exact tops of these rallies. If you're trading and you're focused on the day-to-day, this is an overbought reading. Now, in terms of resistance, these are the two big levels we're looking at, around 4,200 points and 4,300 points. We do expect some type of reaction off either one of these. And from a technical standpoint, once this trend line is cleared, this one here, that's officially when we'll be in a full-blown uptrend. And you'll very likely see a buying panic here, with a lot of people coming back into the market and pushing it back to the all-time high, but still lots of work to do between now and then. The markets don't go up in a straight line. When you have overbought readings and you hit resistance, you are going to get a pullback. You know, we don't put a high weighting on our short-term convictions, right? That's a disclaimer. We're not focused on the day-to-day or week-to-week moves. We're focused on what our end of year target is. We're focused on those longer term trends, on those big moves that we want to capture regardless of the short-term volatility. But if I have to make a bet or a guess on what the S&P 500 is going to do, I think this move here that we've seen looks like the market is front running the peak inflation story and the Fed pivot story a little bit too much and too quickly, right? And when that happens and you've got a market that's overbought, the slightest bad news regarding these bullish narratives, the slightest bad news is going to trigger a little pullback. Or a more sizable pullback if it's really bad news, right? You see oil move higher over the next couple of weeks, or you see bond yields rise a little bit again over the next few weeks. You know, you're going to see this move get retraced, right? And that could be an opportunity for some investors wanting to position on this longer term trend, especially when you take into account the fact that the VIX, the volatility index of the S&P 500, is at support here. It's at this trendline support. You had one reaction here, one reaction here, one reaction there. These all mark the big tops on the S&P 500. Look at this. Right here in December, right here in March, and we're testing that line again, right? So this is not a prediction, but when you've got the VIX at support, that's usually when you don't want to be buying. And for investors who are pessimistic on the market, and I know there's a lot of you out there, a lot of people looking for much lower lows on the market, you want to be shorting essentially the S&P 500 when the VIX is at support. Now, if you're an investor and you don't care about the short-term price action, this is what we think the risk reward looks like right now on the S&P 500. We do think our target for the S&P 500 on gameoftrades.net is around 5,300 points, which is around 30% from current levels. That's a nice powerful bull run, and these are the big areas of support on the S&P 500. Nobody has the crystal ball, whether that's Jamie Dimon, Ray Dalio, Stanley Druckenmiller. All of these guys have different opinions on the market, and yet all of them are successful, and that's because the only thing they do the same is play the odds when they are very favorable. And that's exactly what we try to do at gameoftrades.net, because you guys don't have access to the research provided by these big institutions, by these big hedge funds, trying to provide the only high quality investment research service for individual investors is our mission at gameoftrades.net, and something we work on actively every single day. So I hope you guys enjoyed this video. If you did, make sure to smash that like button. Click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.